Taking forever. Oh,
Yes.
and we're live. That took a little longer than normal to get going. We've been
7
sitting here
minutes
for 7
late
minutes.
again. Yeah, right.
Yep,
Stupid machine.
right.
Yeah.
Anyway, happy Thursday, Jeff. First
Happy
up,
Thursday to you.
thank you, sir.
Yeah, it's
We have
basically the
something.
weekend.
It is. It feels like the weekend. I thought it was Friday all morning, and then I realized it wasn't. I was like, "Damn it, we're going to Top Golf on Friday night," and I thought that was tonight.
Wow.
So it's not. I got to wait another day.
Next week, this will be your Friday night.
Yes.
Yeah.
Absolutely.
There you go.
Cool. So today we're going to talk about something pretty special. We've talked about deal structures before. You can go to the unit section in the group to see our past trainings. We did a deal structure overview, but today I wanted to talk specifically about 8-figure deal structures. So you can get behind the scenes of some of the 8-figure deals we've been doing, understand how this market thinks, and also not just look at complete buyouts, which is what it is the term if you're selling the majority of your business or all of your business. If you just want to sell and go on to something else, it's called a buyout. But also look at something that I think is going to become more and more popular in the e-commerce world. It already is, but in the mainstream e-commerce world in the coming years is growth capital, where you can actually sell the minority stake of your business, take some chips off the table, but then have the majority of the business still, so that when you grow and scale, etc., you've got that capital partner that'll help you. And we're going to talk about that as an option too, because I feel like in some cases, including a couple we've been talking to very recently, this could be a legitimate secondary option. And I don't think enough people understand what those options look like. So we're going to talk about both sides, but specifically as it relates to 8-figure businesses. The spoiler, I guess, is this growth capital side doesn't really work on smaller deals because there's just not enough equity to go around. It's not as interesting to the investor, that is, specifically. So yeah, excited to get in.
The whole thing about once you've built a business to this level, you've got options. It's not just cut and dried anymore. You've got options. There's lots of people with different leverage that would be interested in something like that. So it's still interesting to sort of listen along, because even if you're not quite at that level yet, because obviously that's the goal for a lot of people to sort of get to that level. And all these trainings are obviously designed to sort of help you achieve that goal. But it's interesting to know once you hit certain milestones, how things change and how much more interesting things become and how much more open investors are. So the 8-figure is another one of those milestones. So yeah, today we'll talk about how different deals are structured. I find that, like, talking to some of the people that do grow these businesses to this level, they kind of get stuck a bit. Right? They've grown this company and it's big and they know they're sitting on something valuable. And, all they know is what they've done before. And they reach this sort of crossroads where they can say, all right, I know it's valuable and I can have a big payday here. And I'm still kind of, in a position where I can go back and repeat that. I think I'm confident. And if I, sell for this big, life-changing amount of money, I can use some of that to apply what I know and start it again. And so, okay, you could do that, because it seems like that, to bring that 8-figure business to the next level just seems to be insurmountable. To say, okay, I got a bunch of money in the bank, but at this level, that amount of money in the bank isn't going to help me get, international distribution, or it's not going to get me into, major retailers. It's not going to be enough, so they don't really know how to do that. But what they do know is the road they've already traveled worked for them. So let's sell and repeat the process. So yes, that's an option. But today I wanted to, let's get into what they can do once they reach that level. And obviously, Selling is one option, complete buyout. But
Yeah,
what
well,
are the other options?
let's start there because I think most people still want to understand what deal structures look like on a full buyout, but just know that in this conversation as well, we'll be talking about the other options that are available, and some of these are interchangeable, right? We literally had a call. Julie and I had a call. What was it? An hour ago, hour and a half ago, with the company. I'm just checking my notes. Had a call since then. I really like the way they put this. Where was it?
You need to keep
They
a
said,
quote book.
Yeah. What this investor said, they're looking specifically at companies in the 4 to 15 million EBITDA range, so larger businesses. And they said that this was interesting, and it goes to your kind of circles around your point you just made. Said that a company's doing something right if they get to this level. Obviously, they're doing something well in their business, but they typically find that the founder is constrained by something. And my mind immediately went to capital, but a lot of the clients we deal with aren't constrained by capital at this range. It could be risk appetite, which I thought was quite interesting. An interesting way to phrase this: if you're not willing to invest further in the business, roll more of your cash back into the business, you're trying to siphon cash out in case things go away. There's an uncomfortable level there because you haven't taken enough cash off the table to get you to that next financial security level, right? And you might be thinking, well, what if this all goes away and I don't take any cash off the table? Am I going to regret that? So let's use the first avatar of, I've got this to a point, I'm not interested in going further, or I don't have the skill set to go further. I just want to sell. So what do these structures typically look like? Because as we've said before, the sticker price or the multiple that everyone talks about. I like the way you phrased this once in our earlier trainings, that this is a result of the deal. It's not the deal. Like, that's not the goal, is to get the highest multiple. It's a nice side benefit of a really well structured deal. So
this doesn't tell the whole story.
Yes, exactly.
Yeah. All right.
So we'll start. Let's start with, I've got it written down as 70-30, but it should be 80-20. So let's talk about the 80-20 first.
Yeah, and that's something typically you see with private equity groups, right? That's kind of their standard offering. That's kind of where they start, 70-30, 80-20. And you've often called this the second bite at the apple, right? So you're retaining some of that piece of the business, a minority piece of the business. And if you partner with the right person and they grow it in 5 or 10 years, you still get to that benefit when they go to sell again for a higher value. You've got that second bite there. What you don't have control over is any say in how they operate the business as a minority investor. So there's the downside there. But if you want to, I don't know if you want to explain a little bit more about how that 80-20 or 70-30 works.
Yeah. So effectively on the surface level, it keeps you engaged in the business. Now, it depends on the structure of the company that's acquiring. In some cases, they want you to retain management of the business. In other cases, you may have a management team in place. Again, this call that I just had is kind of perfect because this is exactly what they were talking about. They've been doing this for 14, 15 years. They literally just exited a company. So we were talking about that a little bit. The founder had retained 20% in that company. And the private equity term of second bite of the apple literally played out here, where that 20% was worth more than the original cash they took off the table. The 80% they took off the table in the beginning.
Wouldn't that be the dream, huh?
Yeah. So you basically
unreal. So basically, you sold your business twice. That's awesome.
Yeah,
but now,
especially if you're out of
going on.
Be awesome.
Yeah, but you did say though that some people would be expected to maintain a management role. Now, maybe that's a fit for some people, but because it sort of provides that security blanket for some. But I would imagine that there's a lot of people that would not be comfortable to go to bed one night as the owner of a business and wake up the next morning as an employee now of their own business that they started.
Yeah,
not
exactly.
necessarily how people pictured it, but if you've reached that burnout stage, then maybe that's attractive. But yeah, I mean, I could see how that wouldn't necessarily be the first thing that people would want to do, is to all of a sudden be an employee in the business that they started.
Yeah, exactly. And it does, even if you think you're okay with that, a couple of things to consider here is you definitely want to look at this as a partnership. And a lot of this is really you're partnering with this company, especially if you retain equity and they're going to run the business, you're still a partner in that business. So you want to make sure, you want to vet them and make sure that they're the best fit for you. We signed an LOI last week on an 8-figure deal, and we literally had the buyers pitching us, not just giving us their best price, best deal terms. They were pitching why they were the best partner to take this business to the next level. And it really is that case. Like, they're competing for these deals. So even this investor, again, that we were just talking to, he said, they want to find a path to be the best buyer for the business, not just the best offer, except they want to be the best partner because it's a win-win for everyone. So, and the fact that they have a track record doing this is amazing. The reason we mentioned that this is the common private equity structure is, don't be labels don't mean anything. So someone says, I've got a private equity group. So what? There's, I think at last count, there's 40,000 private equity groups. All you need to be a private equity group is not even a website. You could just say, hey, I'm a private equity group. What's behind that really matters. So what deals have you done before? How is your capital put together? Do you have a fund? Do you have investors? This company, for example, after 14 years of doing this, are still effectively an independent sponsor. They go raise capital on each deal, but they have a very specific and unique way of doing that, which I found really refreshing. But again, last week, with all these deals that we were negotiating and going back and forth on, capital surety of close or certainty of close is one of the biggest factors. The next biggest is, so how are they funding? What's the timeline, etc. But then on the other side is, what's the operational expertise on the buy side, and what's the seller, our clients, what are they expected to do after the deal? So, but know that 80-20 is always negotiable. 70-30, 80-20 is always negotiable, and they're not all created equal. If you're taking on a job, you might feel okay about that today, but you might not feel okay about that in 6 months, 12 months time. So often when there is something like that on the table, we advise our clients to negotiate an employment contract and an out. So how to get out of the business. You always want a clear path of how to get out, even if you think you're going to want to stay longer. And we've been dealing with, over the last year, we've dealt with a number of partnership breakdowns that started the business together, and it became quite an ordeal trying to untangle everything. You can imagine what this is like if they're bringing all the capital, and they might be really nice up front, and then you start working with them, and you're like, whoa, this isn't what I signed up for, right? So oversight, what does the day-to-day look like? And like you said, most of our clients want a clean break. They want the company acquiring it to take over and manage the business.
Yeah, this is also answering the question, what does a broker do? You know what I mean? Yes. Like, but I mean, so, but just getting back to being in the position of having these private equity groups or having these buyers pitch you on why they should be the best partner. Again, it just goes back to sort of highlight that a multiple doesn't tell the whole story. To say this, like, oh, I got four times, for my, I could have gotten you 5 or 4.5 or whatever. And it's like, yeah, that's great. But from who? You really need that partnership is really going to become much more valuable, especially if you're retaining a piece of that business. And
then what's the main reason this is offered, Jeff? What's the number one reason rolled equity is offered.
Well, it means they got to pay less up front.
It reduces risk.
Yeah.
Less money at close. It reduces risk. It keeps you engaged in the
keeps
business.
You on the hook.
It keeps you on the hook, man. Especially if you're operating the thing. It's all you at that point.
Yeah, well, you built it, you know?
Yeah.
You built it. You know all of the intimate little details about this business. So you built it. If you just cleanly hand it off to somebody else, it's pretty risky. You know that they'll be able to continue that success. If there's a way to keep you, A, they pay less, and B, they've got you engaged in the business. So it's in your best interest too now. So it kind of works to everybody's mutual benefit, really.
Absolutely. But yeah, I thought it was, once we started figuring out that this was the actual reason, and it makes sense if you just look at it from an investment perspective. You can say, I'll pay 10x for your business, but I'll pay you $1 a year and then a balloon payment at year 100. I mean, I got a 10x, but I got $1 a year. Like, that's ridiculous. Why would I do that? You know? So yeah. It's interesting knowing just why that is positioned, and it's all to improve ROI and reduce risk. So that's why these offers are made like this.
Right. But that's definitely, if we sort of like talk about that on some smaller, some risky deals, there's that earnout component, which is basically hanging that risk around your neck. And, you know, having, you know, rolled equity and a stake in the business moving forward is one thing. But if this is on an earnout basis where all of that risk is on your neck and you have no control in the business moving forward, and if they tank it, they don't pay you.
Yes.
And that's all of that money's at risk. If you put that into some kind of rolled equity and you are engaged in the business, then it's not really at risk.
Yeah, and actually, well, let's talk a little bit about earnouts. While you brought that up, that's a really good point, actually. So we've seen quite a few earnout structures offered recently. We have not gone with any of these with our deals, and it's interesting when you try it with some of these groups. They're really sharp, savvy investors. You know, people aren't raising a lot of money and doing this for fun. They're sharp humans. A lot of them won't turn an earnout into equity. And they'll say it's because of the structure of what they're doing, but what they're actually saying, and they've said this to me privately, is, I won't say who, of course, but they've said that it impacts their return, and they feel they'd be building value for the seller, right? But they want you to take the risk on an earnout. So I think if you know that about a specific buyer, that's a one-sided relationship. That's them saying, I want to pay as little for your business as possible, and I want the future. And COVID was a great excuse for this, but these were offered anyway, right, before, and they'll be offered after. But this is a perfect time to use this as an excuse, right? External forces, the boogeyman's out there, that there's an external reason. So if they take over the business and it doesn't do so well, then they don't have to pay you, right? Now, you might be thinking, well, would they tank the business on purpose? I honestly don't think so. But also a lot of these groups are saying, well, you can get out the door in 30 days or less. Like they don't understand what it takes to run your business. So if you are interested in some sort of an earnout deal, you really want to drill into who's making that offer, why they're making the offer, what the alternatives are, and
what their plans are. What their plans are for the business.
What's the business plan?
How are you going to grow my business? Because you know, if perhaps you've got 5 SKUs and they only really want one. So they tie all this up and then they put all of their effort into that one SKU that doesn't hit the same growth trajectory, and they don't have to pay you anymore. So they basically walked away with your business for next to nothing, and you're left, you know, screwed basically. Yeah, the only way I would ever take an earnout is if it was a cherry on top, if it was a sweetener. Yeah. If you said, okay, I am happy with the sale price as it is, cash in my pocket today,
100%.
And they tack something on top. They're great. We'll pay you an extra whatever. If in over the next 2 years it earns this, great. But if I don't ever get that, I still got my share, what I wanted out of it. If it was just a sweetener, and that's the whole point of having like competing offers from competing firms for your business. If somebody sweetens the deal a little bit with an earnout on top, okay. But if an earnout means that they're paying you diddly up front, and based on all this potential crap, then walk away.
Yeah. So what we try and do wherever possible is we try and take the buyer always wants performance-based earnouts because it's less risk for them. The seller from the sell side, we always try and convert that into either equity if that's interesting to our client. Sometimes it's not, or a seller note. So a seller note is actually financing. It's a legal finance. You become a lender to the business. So it's not you just putting up fictitious cash. You actually have a note, a promissory note, which you can get security on. By the way, not many people know this. You can secure the hell out of these things, but you can take first lien, etc., on the business, and you should be doing that. So your legal team can help you with that. But it's actual legal recourse, so you can go after them if they don't pay that note. So it's more like cash. And there's actually companies out there, we've had a few reach out to us, say, hey, we do note financing. They'll buy it out for 80% today. So you can go sell that note. It's a real thing, right? So, but yeah, we try and convert that earnout to share the risk. So we share the risk in the form of equity. So if there's a downside, yes, you both have downside. If there's upside, you also have upside. We did this on this deal last week where they had a large order coming in from a distributor, and this was abnormal for that business. And we didn't know if that was going to repeat, but that was the intent of the distributor. So if that comes through, that's going to be a massive upside for the buyer, but it's going to take some time, right? So our clients wanted equity there. So we negotiated terms to fit both their needs and also the buyer. They were happy to share that upside too. So, but if there isn't that appetite on either side, a seller note is a great way to secure what that the rest of that payment, right? And again, you still want to be happy with that upfront piece because everything else after the upfront payment is at risk. Even if it's secured, it's still at risk, right? Until it's paid, it's at risk. So there's interest
it's in your bank.
And
there's always a way that it might not find its way there. Yeah.
Exactly. It's funny how that can happen sometimes.
Yeah, or not so funny.
Yes. Yeah. Well, exactly. So things to note on a note. That was silly. Is the term. It's that not all notes are written equal. What we like to do is make sure there's interest on the note. That's negotiable, by the way. We want principal and interest payments spread out over time. The one reason you may not be able to get principal and interest payments, they might say interest only, is because of the lender. So specifically in 8-figure deals, the lender has a lot of say in the deal structure. Actually, they'll have covenants, etc., that say we get paid first, and this debt can't be senior to ours, etc. So you want to know where your debt sits in the cap table, basically, or who's going to be paid when. So you want that to be part of the negotiation. So the amortization period, we've seen 10-year amortization with a 5-year balloon. So essentially they're paying out as if it was a 10-year loan, and then on year 5, it's all paid out. So you basically get 50% plus the interest. So understanding how all that stuff works, you can just ask. You should be able to ask your advisor, Google it, just understand what you're actually signing up for. But more importantly, it's all negotiable. Oftentimes our clients, even though we've gone through multiple deals, they don't, or multiple offers, they kind of forget that things are negotiable. So that's always there. And then maybe we could talk about, do you have anything else to add on seller financing on the note side?
No, I think we're good to move on.
Okay. So what's the next step?
Well,
Should we talk about holdbacks or?
yeah, I don't know where we're doing for time here, but I thought maybe we're sort of running up against it if you want to talk about like this
The
minority.
alternative? Yeah.
Yeah. I think this would be, because I think this is going to become more and more interesting. And like you said at the top of the call, it's not really often considered. So talk about the growth capital minority stakeholder idea, I think, for sort of the last, few minutes here, just to kind of put an exclamation point on this.
So in some cases, when your business is in fast growth mode, you're profitable, so you're able to take out cash, and you think you might be selling too early, but you know you need something else. And like we mentioned at the start of the call, you want to take some cash off the table just to not feel stupid if everything goes to zero next year. An option that you can look into is finding an investor. There's a whole category of investors, they call it growth capital or minority investing, where they don't want to operate the business, right? They just want to provide capital. So sometimes this will be in the form of debt that converts to capital later. So they'll give you a line of credit basically, or they'll buy a piece of the business. You can take that cash as cash, right? Because they're buying 20, 30, 40% of the business. It's usually 30 to 40% is what we see most often on offer. And they'll also, because they're investors, they have a pool of capital that they're wanting to deploy profitably. So if you're one of their portfolio companies, they're very interested in extending you credit at great terms. So they can also become your bank, essentially, right? So especially if you're doing acquisitions, they love acquisitions. If you have international orders, they love orders. On Shark Tank, I think it's Barbara Corcoran. I think they all say this, but Barbara Corcoran in particular, I remember her saying a few times, "We love orders. We'll fund as many orders as you've got." Right? They love the ability to profitably deploy capital, and they're a partner in the business. Not all growth capital partners are created equal. We ran a project to find a growth capital partner recently, and what I could tell you through that process was there's a lot of investors with a lot of capital out there and groups that have raised funds specifically for this, but there's still, similar to the 80-20 private equity groups, you want to make sure they're the right partner for your business. What I would be looking for and what we do look for when we're running a project like this is leverage. We want some, we want some strategic advantage to come with
these guys are pros, man. Getting the money is the easy part. What else can they bring to the table?
Yeah, and someone said this week, not all capital is created equal. It's very true. It's very true.
Well, I mean, if you're running an 8-figure business and you need capital, if you need money, you can go out and get money. But I would think that if you want to take that business to the next level, it's not just money that's the problem.
Yes.
So just wanted to sort of underscore that. Yeah, exactly.
Yeah. You want something else. We've seen everything from the board of advisors on the growth capital group have immense retail backgrounds or consumer product backgrounds, massive exits in the past. So they've walked the whole path, right? They might be going concerns. They might be operating a much larger business. There's a couple that we've been talking to recently that have infrastructure. They have not only distribution access in retail, but they have supply and distribution access in the form of warehousing, international distribution, etc. The physical logistics side of it and distribution. A lot of them have manufacturing capabilities and different verticals. So they can introduce you, again, similar to Shark Tank, what the offer is. Oh, we can put you on QVC or we can put you in the Maverick Stadium. Like, what is the thing that they can bring that it's going to get them a better return too? They want to do this. But how can you shortcut the process of getting from an 8-figure business to a 9-figure business or larger? Maybe you want to go larger. And this is one way to do it. Get an almost infinite capital partner on board and get some strategic leverage. Take some chips off the table as well, but you're still in charge. You're still running the business. You want to make sure though that what that looks like after. So definitely get some references, go talk to some people I've invested in, spend some time, really important, spend it in person. Now, they'll be wanting to do this too. And right now with COVID and stuff, you might need to do a few Zoom dinners or something to kind of get more of a sense, have a beer with them. Happy hour on Zoom, that's quite popular at the moment. But you want to get to know them. You want to see them in some stressful situations if you can, to get an understanding of their personality. There's a lot of these investors that they're professionals at managing people.
Mm-hmm.
So they'll often seem really friendly on the front end until something goes wrong. So you want to try, you don't want to manufacture something wrong with your business, more importantly, but you want to try and observe that at some point. And that's with the references. That's what you want to understand. How do they act under fire? How do they act under pressure? What do they like to work with? Are they really heavy-handed on the board? Do they ask for more board seats so they can kind of disrupt things if they really need to?
It's like a job interview, right? Tell me about
absolutely.
a time when you had to overcome a difficult situation or whatever, and how you handled it or whatever. Yeah, but it is kind of a job interview in a way. You get to pick and choose who you play with, so it's treat it exactly as that. Money is the easy part.
And that's totally right. And this is the biggest thing, is you want, similar to what we talk about with selling a business, this is actually very similar. We run the same process. We want as many options as possible. We want to see everyone that's interested in your deal. How much leverage do these guys have versus these guys? What's their references like? What is their game plan? What are they like when shit hits the fan? Like, who do we want to do business with? Right? Because you do actually have choice. Even though you may think, well, who could write an 8-figure check for my business? There's a lot of people. There's actually more at the 9-figure range than there are at the 7-figure range, as we've talked about a couple times. So yeah, making sure it's the right partner, there's leverage, and the multiple is less important when it comes to a minority investor. You might still feel like, oh, I want a great multiple. I would put more stock in how much cash you can actually take off the table, and they might have some restrictions around that too. So you want to make sure that you can, if that's your goal, is to take cash out and put that in your pocket, and then what's the terms on the rest of it, etc. So how much can you draw? What's it for? What would they fund? Wouldn't they fund? Etc. So you want to make sure what that relationship's really going to look like. But yeah, you want perspective. You want as many people to talk to as possible.
Yeah. Cool. Well, we're up against the half-hour mark here, so I don't know if we should leave it there. But yeah, it's just interesting. Like when you like I was saying before at the top of the call, that when you build your business to a certain point, the easy thing to do, I think, so let's say you built a $50 million business. Well, I could sell it and build another $50 million business, or I could take my $50 million business, turn it into a $100 million business. And that gap there is that unknown. And these are the kind of things, strategic partnership with a growth capital partner could help bridge that gap and elevate the business to that next level.
It could be having a cake and eating it too.
Exactly. While also taking some money off the table, a significant amount of money off the table. So
and for most people, 10 million bucks, 20 million bucks off the table might actually be a significant amount for most people. If you think about an average lifestyle, unless you're balling hardcore, and if you are, good on you. But if your business is worth 50 and you take 10 off the table, that might set you up pretty well, and then you can keep rolling forward and see where the thing can grow. I like to compete against myself. I don't know about you or anyone else, but my biggest competitor is me. I'm like, how can I do more than I did before? It's this constant, I don't know where this comes from, but it's part of me. I have to beat myself.
Intrinsic, man.
Time. Yeah, it's like I have to. So if you're like me and you don't want to start from scratch, starting with leverage is the best place to start. I'd want to start with a 50 million revenue business. I wouldn't want to start from zero again. There's so much more leverage. Those little tweaks along the way can make a big impact, and the right partner can really set you on the right path. One introduction to the right distributor could double or triple the business. I mean, you still want a game plan. You still might want to sell. It might not be your forever business, and that's cool too. right? But you may just be able to get to that next level and then have completely life-changing money where you could really impact other people. Look at Bill Gates. I mean, people were giving him shit for years about never donating to charity, and now he's trying to wipe out diseases, right? Because he knew he needed so much capital, and he's actually pulling in more capital to try and do this stuff. So it's almost like he didn't have enough when he got there. But you can think outside of yourself and your own family if you get to those levels, which may or may not be interesting to you. Either way is cool, but we want to share all of the options here.
Right. It might just be keeping the fleet of Maserati lease payments going. So whatever your reason is, curing malaria cool or Maserati payments, whatever.
Yeah, you need the jet money, man. Jet money to the yacht money.
Yacht money.
And that's cool too.
Yeah, cool.
That's why we're doing this, by the way.
Oh yeah, 100%.
Awesome.
Yeah.
Cool. All right. Well, yeah, that was fun. Anything else to add there, or I think I should put up this.
Yeah, no, I think if there's anything to add to it, I think we should break it out into another session here. But yeah, if you do want to get in touch, sales@thefbabroker.com, come straight to my inbox. And if you're thinking about selling your business, or if you want to talk about deal structures or strategic partnerships with investors, I mean, if you're thinking about an exit now, in the future, any of those scenarios, send me an email, sales@thefbabroker.com. We'll talk about what your goals are and what your plans are and see how we can help.
Awesome. All right. Well, thanks everyone for watching, and thanks, Jeff. And we'll see you again tomorrow for FAQ Friday.
All right. Sounds good. Bye for now.